is that how GRMs have actually collapsed. Now, earlier this year when the war broke out, the GRMs went to as high as $30. I'm talking about Singapore GRMs used for benchmarking purposes. Now GRMs have plunged below the long-term averages and they're in single digit, threatening to go to a new low, so to speak. The peak of $30, which was hit on 21st of June, and that's the time government came out and put a windfall tax on the refiners. Now the cycle has turned completely. And I think at the current level, our assumption is that oil marketing companies and perhaps companies like Reliance and Chennai Petro, they may actually not be making any they may not be actually making any profit. So why has we've seen such a big tumble down in GRMs, even though the war in the world is still on? The volatility in the global GRMs, which is gross refining margins, has been extraordinary. Mr. MKSurana joins us now, ex-chairman and managing director with HPCL. Mr. Surana, good morning. Thank you for joining us. You're looking much more relaxed in your new avatar, sir.
Beg your pardon?
You're looking much more relaxed, calm and happy in your new avatar.
Yeah, it's good to look fresher.
How's life treating you? What's keeping you busy after in your new role?
Yeah, life always has something to keep ourselves busy, and we can always find our ways to keep ourselves gainfully engaged.
I'll tell you what is confusing us. What is confusing us is this extraordinary first spike and the drop in GRMs. The reason why GRMs expanded was because of the war. Logical, war in the world, supply constraints, GRM went up. Even though the war in the world is still there and supply constraints are there and OPEC has not agreed to increase their production, GRMs which were at $30, they've come down to $7 or $8. Why is this happening?
So let's understand the dynamics of it. Why did the GRM went up earlier and why did it come down now? So the GRM is a function of product prices minus the crude prices. The product prices, especially the diesel and petrol and LPG also, the cracks increased substantially. The reason being that the Chinese export, which was coming in the market, reduced, and some of the refiners went on shutdown. Some of the refiners reduced the throughputs because of various reasons, and therefore especially diesel, and there were some geopolitics and there was some speculation regarding the Russian exports coming, not coming, the European imports from Russian route, etc. Various reasons, the geopolitical plus speculation plus the technical. And the diesel cracks went up to $60, the MS cracks went up to $25, LPG prices going through roof, and the sum total of that was the Singapore GRMs also going up substantially. Now the product cracks, the diesel has come down to around $30. MS cracks has come down to around $1 or $2. Now neither of the two extremes are actually sustainable. Neither the $60 of diesel crack is sustainable thing, nor $25 is a very good thing of MS, but definitely not even $1 or $2 of MS crack is sustainable. But sum total is that the product crack has started climbing down. Now, as far as Singapore GRMs are concerned, they are more loaded towards the MS cracks and lesser to diesel compared to what the Indian refiners have, the diesel component of it, the way the Singapore GRMs are calculated. And therefore, because of LPG and MS cracks down, the Singapore GRMs plunge down more than what the actual GRMs will plunge, especially the Indian refiners who are loaded towards diesel. Now, what is the reason for cracks going down? That is also something to do with the demand and the recession fears and the inflation and the high prices and also the dollar. Now, the US normally guides the gasoline demand, but the summer season driving did not pick up the way it was supposed to, and now it is slowly receding. The diesel demand is normally guided by the European part of it, but there is a recession fears. And therefore, a lot of people, speculators, will be winding down their positions. And therefore, if you see today, the Singapore GRMs are coming, and of course, there will be some play related to The timing also, because the Singapore GRMs are based on same day crude, same day products, while the actual thing works on the actual timing of when you buy the crude and when you process. So that answers the questions for lower Singapore GRM. And the higher GRM earlier were mostly because of the higher price of MS and HSD. Now the LPG prices also subdued a bit. The MS cracks has subdued a bit. Diesel has come down from its high, but still it is high.
Right. Mr. Surana, the one thing which I guess all of our viewers and all the consumers want to know is that crude has cracked from $130 to $85 to a barrel. When will petrol and diesel prices start to reduce?
I think the diesel and petrol prices are based on a crude price currently, which is lesser than that.
Yes, lesser, but I guess not enough for the consumer to actually believe that. But just coming back to the Singapore GRMs and the kind of negative territory that they're currently in, which you were just alluding to. The other question, of course, is should the government be removing then the windfall tax?
As I mentioned to you, that whether the government should reduce the windfall or not, that is definitely the government's prerogative, and I can comment on that. But two things: the Indian refiners GRM should be better than the Singapore GRM, because the Indian refiners product slate is loaded toward diesel, and diesel cracks are still healthy, while the Singapore cracks are more loaded towards petrol and LPG and lighter components. So that's one part we need to remember. Now, the second part is that the overall GRMs of the Indian refiners, I expect that this should be better than what the Singapore GRMs are seeing right now, because there is also a time lag between the timing, the way the Indian GRMs are calculated based on the actual timing of the crude and the product slate, while the Singapore GRM are based on the same day crude and same day products. It can work either way, depending on how the crude prices are moving and how the product prices are moving. As far as domestic prices are concerned, one of the reasons for domestic prices being high is also the higher dollar rate, which is almost owing to all-time high. And while the cracks have come down, so that should help. The crude prices have come down, that should help, but the dollar is going up, that should not. And all the high range cracks and crude prices were not factored in the domestic prices, which are currently ruling. So I think while the situation is slowly becoming more conducive for the prices to be market determined.
Sure. So, Mr. Surana, two things here. What is the impact then of this sharp drop onto GRMs and crude prices on various companies? I mean, there's Reliance, there's HP, BP, IOC, there's Chennai Petroleum, there's MRPL, which all are sensitive to the way Singapore GRMs pan out. And the other thing is, does that really mean that refining crude is unviable then for Indian refiners in any which way?
See, this crude is a cyclic product, and the refining also is a cyclic system. So we can't judge that whether it is economical, not economical on day-to-day basis. I continue to believe that the Indian refiners should have the GRM, which is sustainable, even if the current MS cracks are low, because the diesel cracks are quite high. In fact, if you remember some time back, the diesel cracks and the MS cracks were both in the single digit. Sometime it was even negative also. But today you are having a diesel crack of even $25 or $30. That's a very, very healthy cracks. Otherwise, normally a $12 crack is considered a reasonable crack. So while you may not have the GRMs of double digit, what you might have seen in the recent past, but I think there should still be a reasonable GRMs on this, if purely calculated based on the international prices.
Okay. So just to wrap it up with one final point, Mr. Surana, what would be the most important dynamics which would be at play? Will it be the supply side disruption because of Russia and what is happening to Europe, or could it be ultimately demand which would drive GRMs?
Nikunj, there are factors on either side, and they are pulling the things in opposite directions. On the supply side, OPEC may still come out with something to, based on the recent statements, whether they will again go for some production cuts if the prices are to go down, and they may like to defend a base of $80 or so, may not be $90. So that is one side which may bring some supply side constraints. Also, we need to remember that out of the authorized quota, also there is a shortfall of around 3.2 million barrels per day on the OPEC plus supply as of today. And the surplus capacity on the OPEC side is slightly waning out. So how much surplus capacity is really available? That's a question mark. Really, which can be deployed immediately. Now, if the European ban has to fructify on Russian oil, then the Russian oil will find the place in other parts of the world. There are some disruption which may come because of the hurricanes, whatever we are saying, a series of this possibility. Some of the disruptions in some of the Latin American and African countries, which may disrupt some of the supplies. On the demand side, you have got a pressure of global recession, especially in major economies, especially in Europe, US, etc., which is giving certain strain on the prices. And therefore, depending on how it plays, but I think it is more likely towards 80 rather than 90 now. And I don't think that it can plunge down to 60 immediately, nor it is likely to go to 100. And therefore, it will play by the news item. And now the Iran settlement looks a bit distant on right now. So therefore, the additional barrels coming on up is unlikely. Even the US rig count is not reached a high all-time high. I think it is around 602 or something, while in last March 20, we had around 683. So we need to see how the geopolitics works, especially Europe, Russia, Ukraine war, and how the OPEC's view is there on this.
Right.
And
Sure.
there will be play between recession and this.
Sure.
That's later.
Mr. Surana, pleasure having you on board. Thank you so much for joining in and giving us an outlook on the overall crude oil price move, as well as, the windfall tax.